Let's shift focus now to the other big story. This is coming from the startup space. Has our company and the industry been going through a troubled time? Absolutely. Did we make errors in execution? No doubt about that. Well, this is an excerpt of the letter that Snapdeal founders have written to their employees. The letter has been sent amidst reports that the firm is all set to lay off about 500 to 600 people as soon as in a week's time. For more on these developments, Shereen joins in with all the details. So Shereen, many would actually say that the layoff decision is on expected lines. Would you agree with that?
This is not unexpected, and I believe that the news from Snapdeal is a cautionary tale, and perhaps we are going to see a lot more of this kind of news coming in from the Indian startup space. Snapdeal today announcing that it is realigning its resources with a continued focus on efficiency and profitability. What that essentially means is that they are now going to be cutting down on operations. They will be making choices that hopefully will bring down costs for the company, and they will be retrenching people. Now, that's the hard one, because they are going to have to let go. We are given to understand anywhere between 300 to 500 people. They are expected to do this in tranches. In the first tranche, maybe 300 people are going to be asked to move on with a 3-month severance package. An acknowledgement of the trouble at Snapdeal being articulated in this letter that's been sent out by the founders to employers. And a plain reading of this letter tells you what is wrong with India's startup universe. These are problems that we've been highlighting for a while now. Too much capital, too much growth, too aggressive in too little time, a problem of managing the kind of growth with very young teams, investors who have been very, very aggressive. Those are the problems that are now making companies like Snapdeal make the decisions and make the hard, tough choices that they are having to make. Let me read out some crucial excerpts from the letter that explain to you the malaise and the problem. Has our company and industry been going through a troubled time? Absolutely. Did we make errors in our execution? No doubt about that. Over the last 2-3 years, with all the capital coming into the market, our entire industry, including ourselves, started making mistakes. We started growing our business much before the right economic model and market fit was figured out. We also started diversifying and starting new projects while we still hadn't perfected the first or made it profitable. This, in essence, is not just a Snapdeal problem. It's a problem that we're seeing across a lot of startups in India. Too much in too little time, diversifying, a problem of plenty, and that's coming now to bite. Let's now talk about the other excerpt from this letter. This also comes with some tough decisions in the short term. As part of our overall path to profitability plan that's currently in full swing, we will be reorganizing the company into a lean, focused and entrepreneurial one. We're combining teams, reducing layers, eliminating non-core projects and strengthening the focus on profitable growth. Sadly, we will be saying painful goodbyes to some of our colleagues. This is by far the hardest decision that we've had to take. So an acknowledgement there that, yes, there will be retrenchment. And finally, I think in the last part of this letter, the lesson really for founders, the lesson for startup companies, and the lessons really for corporate India or for entrepreneurs anywhere around the world. Let me quote that last line to you. This will mean tough choices and a conscious departure from a Me Too race to the edge of the cliff. Let's remember, GMV is vanity, profit is sanity. All these years, we've been talking about GMV and the high numbers that founders of these companies have been throwing our way in terms of GMV as a big achievement, as a big milestone. And today, there is an acknowledgement that at the end of the day, cash is king, cash is what matters. Keep your eye on the ball, keep your eye on profitability. So it's a hard day for India's startup ecosystem, but perhaps many important lessons and takeaways, and we do hope that there are learnings from this.
Oh, absolutely, Shereen. Thanks for that. In fact, let's take the conversation forward. We have Mr. Mohandas Pai joining in. Of course, he's someone who's been very closely associated with the entire startup ecosystem. So what is really going on? I mean, we've been getting repeated reports of the markdowns, whether it's been Flipkart or some of the other e-commerce giants, now retrenchments, and the language, as Shereen was pointing out, I mean, an admission that all this while the GMV headlines, I mean, that wasn't really reality. The reality was profitability. Why has it taken so long for, some of the startup tycoons of this country to recognize that?
Well, first of all, let me say that they had no clear strategy. They had very poor execution. They were egged on by people who wrote very large checks and told them to spend it in the hope that they're going to get more money. and it all blew up. And it's supposed to happen some time back. Is now it's coming up to the fore because nobody's giving them checks. Earlier, it should have happened 1 year back. Is giving them checks. Let me give you some examples. There was a sale of Apple iMacs for 20% less. You can't sell Apple iMacs for 20% less. Many of the people in the office were excited. They went and bought 15, 20 iMacs. They ran out of stock. They went to a neighboring shop, paid 5% premium, and sold it and said, GMB, GMB, GMB. And then in another instance, a young man who was working in my office spent 100,000 rupees on mobile wallets and got 20,000 cash back. But where is this money going to come? These are all businesses. And most of the sales, 65% of sales is for people below the age of 35. And if you look at this GMB business, you sell it for 25% discount and 20% returns. You get maybe 55% and then declare 100% as the GMB. And that the discounts are shown below the line as marketing costs. So many of them were fudging the books. Many of them were hiding this in the hope that they can do because they were driven by one big idea, winners take all. They thought they can outspend anybody and become a very clear winner. If you look at Amazon, after so many years of e-commerce, they're still at $105 billion. Walmart is $450 billion. They're still making losses on e-commerce. They make money on AWS. In India, too, all these people were blowing up cash, paying fabulous salaries, hiring thousands of people, taking huge offices, not knowing that how to run the business. They were all engineers, not business people. I think the model was wrong. We knew it is coming, and it's good it is coming now.
Right, strong words there, Mr. Mohandas Pai. And while you're saying that the financials were not sustainable, the other big, really, the big takeaway from the letter that the founders have written is that perhaps they did too much too early. In fact, if I were just to quote one line from the letter to you, here Kunal says that we started growing our business much before the right economic model, which again, is something that you are talking about. And we also started diversifying and started new projects while we still hadn't perfected the first or made it profitable. And this is not just with Snapdeal. We've seen with other e-commerce giants also trying to do too much too early. Many times when we speak to some of these companies off record, they do sort of, imply that a lot of times there's also a lot of investor pressure because, looking at, the Alibaba model in China where Alibaba is doing a whole host of things, there's a lot of investor pressure also on these firms to do too much too early. Do you think that's a, that's sort of a fair observation that some of these companies are making?
Well, Alibaba took 20 years or 25 years to come to where it is. Alibaba, Jack Ma was very frugal. He didn't give away freebies. He earned his cut on every sale that happened. He built a fantastic supply chain and delivery. And these people are not perfect at the art of delivery, logistics. They're losing money on logistics. Like you got a hotel, food delivery company which loses 25 rupees on every order. They just don't know what to do. And if they raise the price, they're going to go out of business. Now, even the investors have been egging on because all of them believe is a winners-take-all market. And the winners-take-all market will come when you're in a small market. There is not much of competition. In India, you have formidable competition retail like Kishore Bayani. They should have appointed Kishore Bayani as their mentor and as a consultant. Kishore would advise them how to run the company. Kishore has been talking about it. And of course, all of us and many of us said Kishore is old hat, his legacy. Now, Kishore must be laughing all the way to the bank. He's still got a bank balance. He's got a great business. He's planning to go up to 100,000 crores. And he's still around with the market value going up. If Kishore is listening, I'm sure he'll be chuckling. Reliance Retail is going very well. So, in basic bad strategy, the investors pushing them, and the investors were people who have never built a business before. So if you have an MBA finance person who goes on throwing money, but has never run a business, never operated a business, never been successful in business, but become an investor and egging on and not being an operating person, is a perfect recipe to a disaster. It's going to happen again, it's going to happen again, it's the nature of the beast. So, we should not be surprised about all this.
Okay, Mr. Pai, please do stay on. We have Rahul Khanna also joining in. He's managing partner at Trifecta Capital. This is a fund that, of course, invests in a whole lot of startups, including, I was just checking, something like an Urban Ladder. Rahul, good to have you into this conversation. So, Mr. Pai has been categorically saying there was no great model, there was no sustainable, profitable model. And now that a lot of the co-founders are acknowledging that, what happens next? Are you going to expect more write-downs, more markdowns? Is this it pretty much in terms of retrenchments? Is it going to get uglier? How do you see the next couple of months play out till this settles?
Sure. So I think, clearly up to 2015, there was a tremendous amount of capital available to these companies. And clearly, I think growth was being underwritten by dollar capital. 2016, we saw things slow down and we saw a lot of companies trying to course correct. Part of that course correction is getting rid of unnecessary expansion and businesses that were not core. And tied to that is also, probably doing significant reductions of people. Because I think, tied to a lot of unnecessary expansion was a lot of lofty hiring and lots of wage inflation. So I think as we talk to founders, the good thing about Indian entrepreneurs is they're pretty savvy. I think they read the writing very clearly. And, sometimes you have to take some very tough decisions. I don't believe that, this is necessarily the exception. I think we will see more people pulling back. But equally, I think, venture capital is an industry that grows in waves. And we've seen one wave. This one has ebbed a little bit. And, there's other waves building. So I think we should just bear in mind that we've actually graduated a whole generation of customers into being digitally savvy and comfortable transacting online. And we have to thank investors for underwriting that. So I think in a lot of ways, now, we see a next generation of entrepreneurs who will have learned from these mistakes.
Absolutely. Fair point, Rahul. Just hang in there. In fact, just to stick to that point of investors, Mr. Pai, because we all know that when you make an investment, you know that there is a gestation period. But, a lot of times people look at, Amazon to say that, hey, Amazon didn't make any money from 1994 to 2000. In fact, every year they made more losses than the preceding year. So, so does it make more, your life more difficult? Because, you need to eventually make a call whether you should invest more in the hope that the business will turn around, or do you, say that, okay, we've invested a lot and now it's time to cut our losses. Is it making life more difficult for investors like you, Mohandas Pai?
See, we invest in companies where we are willing to take a loss, provided there's a path to profitability and sustainability. Because when you want to grow at 100, 200% a year upon year, you have to invest ahead of need. You have to build marketing capabilities. You have to build people, systems, and all that we understand. But there has to be a way to sustainability 2-3 years down the line. It cannot be an endless way to sustainability with the losses growing, not revenues. The losses becoming larger than revenues. That is unsustainable. We too have made mistakes, but we make small amounts of investments. Our write-offs are not so high, very, very small, maybe 5-7% of some funds, that's all. But we get away from these places where the founders are intent upon making larger and larger losses in the hope that more money will come. It is a key issue which has happened is there has been irrational exuberance. Valuation moved ahead of value creation. Valuation has now corrected. It will wait for value creation to catch up with valuation before the next thing comes. And many of the companies now will have to be marked down deeply, almost sold at bargain prices. And maybe new investors will come and put in money and take a larger stake and dilute everybody else out of existence. And maybe they'll put in a new team to take it up. I mean, this is the nature of the beast. We should not be surprised. This is the way venture works, this is the way the industry works. And this is the way we're going to see waves of it in future.
Rahul, just a quick question on the markdowns as well. I mean, Morgan Stanley, Fidelity, all of these international big names, they've been taking markdowns of 30%, 35%, depending on which Indian company you're looking at, which Indian e-commerce player you're looking at. Are you expecting more markdowns? And then really a simple question, but maybe tough to answer. What is a sustainable model? I mean, what would you look for before you actually sign up on the check as you're handing it out to one of, the new startup boys?
Sure. Look, it's very hard to generalize on the right model. And I think in India, generally, it takes almost a decade to build a sustainable business. So if you look at companies that have actually created value, a Make My Trip or a Naukri or a BillDesk, these are decade-old businesses, if not longer. So I think one of the things that, investors need to focus on is who are you backing, as opposed to what is this specific model. The model will change. In a 10-year period, regulation changes, competition changes, pretty much everything changes. But the team that you're backing and their maturity, their ability to course correct, to hire the best people, to grow on a sustainable basis, that's really the bet that a quality investor should take. So I think we should, maybe stop looking at copycat models and really saying, here's high-quality people going after large opportunities in a sustainable fashion. And ideally, that's the team we should be backing.
Rahul Khanna, Mohandas Pai, thank you very much for joining us here on India Business Hour and giving us a perspective on that important development.